Do farmers also pay tax? The real story of the exemption on farming income. The early morning haze has not fully cleared yet. A farmer standing on the edge of his field is looking at his crop. Dew had fallen all night. The weather still cannot be fully trusted, and what price he will get in the mandi is also not yet clear. But at the same time, another question is circling in his mind, one that confuses people in cities too. Does a person who earns from farming also pay tax? This is where the fear begins, because half-baked knowledge of the law often creates unnecessary anxiety in people. Someone says all of a farmer's income is forever tax-free, someone says the government will now impose tax on farming too, and someone assumes that whether you sell land or do factory-like farming, everything will automatically come under exemption. This is where curiosity is born. What do the real rules actually say? And in what situations does a farmer truly remain outside tax? And in what situations does the story change? First of all, understand one direct and clear thing. Under income tax law, agricultural income is given exemption. The official material of the Income Tax Department and Section 10(1) clearly say that agricultural income is not included in total income. That means if the income is truly agricultural income, then normal income tax does not apply to it. That is why, for a long time in India, the belief developed that farmers do not pay tax. But the biggest mistake here is that people treat agricultural income and every kind of income of a farmer as the same thing. The law does not see it that way. The law first looks at the nature of the income, the source it has come from, and whether it fits into the definition of agricultural income given in Section 21A or not. This is where the real story begins. According to Section 21A, agricultural income can broadly be of three kinds. First, such rent or revenue that comes from land situated in India which is being used for agricultural purposes. Second, such income that comes from carrying out agriculture on that land or from doing such ordinary processing work as makes the produce fit to be taken to market. Third, in some circumstances, income from a building that is being used for a purpose connected with agriculture on or near that land, such as a storehouse or a necessary building used by the cultivator. That means the law does not look only at the word agriculture, it looks at the nature of the activity. If the land is in India, is being used for agricultural purpose, and the income has arisen from that agricultural activity itself, only then does the foundation of exemption arise. Now understand this in simple language. If a farmer grows wheat, paddy, vegetables, fruits, or some other crop on his land and earns by selling them, then this will generally fall within the scope of agricultural income. If he does that ordinary processing which a normal cultivator does in order to make the produce marketable, then even then this income can remain agricultural in nature. But if the activity goes far beyond the normal boundary of farming and the character of the income changes, then it is not safe to assume that every amount is automatically tax-free. That is why the law uses its wording very carefully. It speaks of agriculture and ordinary process to make produce fit for market, so that a distinction remains between farming and a pure business operation. This is exactly where many people get confused. Suppose a farmer's income is not coming only from selling crops, but is also coming from shop rent, salary, interest, commission, transport business, property income, or some other non-agricultural source. Then the picture changes. The income from farming may remain exempt, but normal tax rules can apply to the non-agricultural income. On the farmer's page of the Income Tax Department, it is clearly written that if agricultural income is more than 5,000 and non-agricultural income is above the maximum exemption limit, then a special method applies, which is called partial integration. This does not mean that agricultural income has been directly taxed, but it means that agricultural income is added into the calculation for determining the tax rate so that the applicable rate on non-agricultural income can be worked out. This partial integration sounds technical, but in reality, it is a subtle rule. The government is not directly imposing tax on agricultural income by adding it to taxable total income. But if a person's agricultural income is large, and at the same time, the non-agricultural income is also above the exemption limit, then agricultural income may be considered for tax rate calculation. The farmer's page also makes it clear that this rule mainly applies to specified assessees such as an individual, HEOF, AOP, BOI, and for this both conditions are necessary. Agricultural income must be more than 5,000 and non-agricultural income must be above the basic exemption limit. So saying that agricultural income is always totally irrelevant is also not completely correct. Many times, it comes back to the calculation table for rate purposes. Now comes the biggest practical question. Does a farmer have to file an ITR? The answer to this is not black and white, but situation-based. If a person's income is entirely exempt agricultural income, and there are no other taxable triggers on top of that, then normal income tax liability does not arise. But the moment non-agricultural income gets added, a capital gains issue comes in, or other return filing situations arise, then ITR may become necessary. In the instructions of income tax return forms, there is also a provision to report agricultural income in the exempt income schedule, and the farmer's page of the Income Tax Department explains how partial integration is calculated for a person having agricultural income. So it is important to understand that income from farming is exempt, and I will never have anything to do with filing a return are not the same thing. Another major confusion is about selling land. Many people assume that if land is agricultural, then every income arising from selling it will also be tax-free. But the official capital gains guidance of the Income Tax Department makes it clear that exemption may apply only in the case of rural agricultural land. Under Section 214 IE, some agricultural land remains outside the definition of capital asset, but not every agricultural land. If the land falls within certain limits of a municipality or cantonment board, or within a notified distance, then it may be treated as a capital asset. On the department's capital gains page, this framework is also explained on the basis of population and distance. The meaning is clear. The question of tax on sale of agricultural land will not be decided only by the fact that farming used to happen on that land. It will also be seen whether it is rural agricultural land or whether it falls into the category of an urban side capital asset. That means if a farmer sells rural agricultural land in a far-off village, the situation may be different. But if that same land is in an area that falls within municipal limits or specified distance rules, then the question of capital gains tax may arise. That is why, in matters of land sale, relying only on people's opinions in the village or on local habit can be dangerous. Tax law looks at the map, population, jurisdiction, and legal classification. A small oversight here can later turn into a big demand, notice, or confusion. So in the case of land sale, a simple thought like, I am a farmer, so no tax will apply, is not always correct. Now, let us talk about that income, which people think is connected with farming, but which the law does not so easily treat as exempt. Section 2(1)(a) talks only up to ordinary processing. That is, that normal process which a cultivator generally does to make the produce marketable. But as the activity moves toward processing, branding, manufacturing, the trading chain, the packaging chain, or an independent business model, every such income stream does not remain agricultural income. The language of the law has been deliberately kept limited so that a distinction remains between farming and a pure commercial business. So if the activity has gone far beyond farming and taken on a business structure, then the tax treatment may be different. In this area, the facts become case specific, which is why a blanket assumption is the biggest mistake. That is why saying a farmer does not pay tax is just as incomplete as saying every kind of income of a farmer can be taxed. The truth lies in between. Genuine agricultural income arising from growing and selling crops gets exemption. But if that same person also has salary, rental income, interest income, trading business, capital gains, or a land sale that falls into a category where capital asset rules apply, then tax law will look at the other sources differently. And if agricultural income is large and non-agricultural income is above the basic exemption limit, then tax rate calculation may also change through partial integration. This is the detailed reality that often disappears in headlines. Now understand one human aspect. Why is exemption given to farming? Its official provision is seen in Section 10(1), but behind it lies India's economic and social background as well. Farming depends on the weather, crop risk is very high, income is not regular, and for a very large section, agriculture is a source of livelihood, not a fixed salary stream. The current structure of the law reflects exactly this thinking, that agricultural income should be kept outside the general income tax net. However, the department's material also shows that the rules are detailed, the definitions are narrow, and classification is extremely important in order to prevent misuse. That is why every receipt in the name of agricultural income is not blindly treated as exempt. Many experts and policy observers do keep raising from time to time the debate over how transparency can be increased in cases of large-scale agricultural earnings, corporate-style activity, or misuse. Even white paper material connected with the income tax department records the concern that agricultural income claims can become a route for misuse if there is no verification, and it also raises the question of the role of states and variation among them. But one important thing must be understood here. Policy debate is one thing, and the law currently in force is another. At present, the legal position clearly visible from official sources is that agricultural income is exempt, but its definition is strict. Capital gains rules are separate, and the tax picture can change the moment non-agricultural income is added. If this is summed up in very simple language, then normal income tax does not apply to a farmer's genuine agricultural income from crops. But the moment the source of income changes, such as salary, rent, business, interest, or certain land sale situations, tax rules become active. If agricultural income is more than Rupee 5000 and non-agricultural income is above the exemption limit, then tax rate calculation can change through partial integration. And if the land falls under urban side rules, then the question of capital gains tax can arise on its sale. These are the three things most worth understanding: the nature of income, the legal category of the land, and the presence of other income sources. So the next time someone says that a farmer never pays tax, do not take that as the full truth. And if someone says that now every farmer will have to pay tax, do not get scared of that either. The correct thing is that the law gives relief to real agricultural income, but it does not treat every receipt as agricultural income. The difference lies in this understanding. Without understanding the soil of the field, the mandi price, the risk of weather, and the language of the law together, the right answer does not emerge. A farmer's world is not only of plow, seed, and water. Now he also has to understand papers, category, and tax rules. And perhaps that is the biggest truth today. As important as earning is, it is equally important to know by what name the law recognizes that earning. If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.